Investing in pharmaceutical stocks is thrilling and risky. For every overnight success, dozens of companies burn through cash and never make it. You can't just follow rumors, you need to dig into the numbers and the science. Today we're breaking down 4 pharma and biotech stocks: Cyclacel Pharma, CYCC, Kairos Pharma Ltd, KAPA, Rich Parkle Holdings, ANPA, and LQR House Inc, YHC. Each has a unique story and potential for growth, or disaster. Let's dive in, starting with CYCC. First up, Cyclacel Pharmaceuticals, CYCC, a clinical stage biopharma focused on cancer treatments. Their main hope lies in 2 drugs, fadraciclib and plogosertib, both targeting the cell cycle to stop cancer growth. The stock is volatile, swinging wildly on clinical trial news. Cyclacel isn't profitable, it burns cash fast, so watch their balance sheet and any new stock offerings. The upside: if their drugs succeed in late-stage trials and get FDA approval, the stock could skyrocket. The risk? Failure means the stock could be wiped out. Investing here is a bet on their science and management. Think lottery ticket, not steady investment. If you can't stomach big swings, this isn't for you. Watch for trial updates and cash runway. This is a high-stakes, hands-on investment. CYCC is all about potential breakthroughs, but the risk is just as big as the reward. Next, let's talk about Kairos Pharma Ltd, or KAPA for short, a company that stands out in the pharmaceutical sector by taking a distinctly different approach from the typical biotech or pharma firm. While many companies in this space pour billions into research and development hoping to discover the next blockbuster drug, KAPA's strategy is more about smart business moves than scientific moonshots. Instead of spending years and massive resources developing new drugs from scratch, KAPA focuses on acquiring or licensing drugs that are already in late-stage development or have even received regulatory approval. Their core business is to take these proven or nearly proven products and maximize their commercial potential, bringing them to new markets, expanding their reach, and optimizing sales channels. This business model is generally considered less risky than the high-stakes world of pure biotech, where a single failed clinical trial can wipe out years of work and millions in investment. But make no mistake, success here still requires sharp business acumen. The company's future depends on making smart acquisitions, integrating new products seamlessly, and managing a growing portfolio with discipline and vision. As an investor, you'll want to dig into some key questions. What drugs does KAPA actually own or control? Are these products gaining traction in the market? Is the company seeing consistent sales growth, or are revenues stagnating? The answers to these questions can reveal a lot about the company's prospects. Another crucial factor is how well KAPA integrates its acquisitions. Buying a promising drug is just the first step. Success depends on how effectively the company can bring that product into its existing operations, align teams, and avoid costly disruptions. Smooth integration can unlock value, while poor execution can lead to missed opportunities and wasted resources. The main risk with this model is execution. If KAPA overpays for a drug, misjudges the market, or fails to integrate a new acquisition, the consequences can linger for years. Bad deals or mismanagement can drag down profits, damage the company's reputation, and erode shareholder value. That's why the financials matter so much. Look for evidence of growing revenues, improving profit margins, and a healthy balance sheet. Strong cash flow and manageable debt levels are signs that the company is executing well and has the resources to pursue future opportunities. KAPA's growth strategy is all about building a diverse portfolio of products rather than betting everything on a single experimental drug. This approach can provide more stable, predictable growth, and it helps insulate the company from the risks of any one product failing to meet expectations. Ultimately, when you invest in KAPA, you're betting on the management team's business skills, their ability to spot opportunities, negotiate deals, and execute on their strategy. It's less about scientific breakthroughs and more about operational excellence and strategic vision. So, do your homework. Research KAPA's acquisition history, look at the track record of its leadership, and see how well they've delivered on past promises. A strong, experienced management team with a history of smart deals and successful integrations is a major asset in this business. The upside of this model is the potential for steadier, more reliable growth, especially compared to the wild swings of early-stage biotech. But remember, this isn't a get-rich-quick play. Returns may be more gradual, but they can also be more sustainable over the long term. In short, KAPA is a company for investors who value business fundamentals, operational discipline, and steady growth over the high-risk, high-reward world of biotech moonshots. If you're looking for a different kind of pharma play, one built on smart deals and solid execution, KAPA might be worth a closer look. Third, Rich Parkle Holdings, ANPA, is what's known as a holding company. Its value doesn't come from making or selling products directly, but from the collection of businesses it owns underneath its corporate umbrella. Think of it as a parent company, quietly pulling the strings behind the scenes, with its financial health and future prospects tied directly to the performance of its subsidiaries. This structure can make it both intriguing and mysterious for investors, because what you see on the surface is only a small part of the story. To truly understand ANPA, you have to peel back the layers, just like an onion. Each subsidiary is a piece of the puzzle, and you need to ask, what do these companies actually do? Are they leaders in their industries, or are they struggling to keep up? Are their markets growing, or are they shrinking? The answers to these questions are crucial, because the value of ANPA is really the sum of its parts. The best place to start your investigation is with their SEC filings. These documents are packed with details about what ANPA owns, how much those assets are worth, and how they're performing. Pay special attention to the net asset value, or NAV, which is essentially the total value of all the company's holdings minus its debts. Compare this NAV to the current stock price. Sometimes you'll find that the market is valuing the company at less than the sum of its parts. When a holding company trades at a discount to its NAV, it can look like a bargain. But be careful, this discount often exists for a reason. It might signal that investors are worried about hidden risks, such as opaque accounting, hard-to-value private businesses, or management decisions that haven't paid off. Sometimes the market is simply skeptical about whether the reported asset values are real or achievable. The future growth of a holding company like ANPA depends almost entirely on two things: how well its underlying businesses perform, and how skillfully management allocates capital. This means you're not just investing in a collection of companies, you're also betting on the leadership's ability to make smart decisions, buy and sell businesses at the right time, and reinvest profits wisely. But with this structure comes risk. The more complex the web of subsidiaries, the harder it is to see what's really going on. If ANPA owns private companies, it's even trickier. Private businesses don't have to disclose as much information, so you're often left guessing about their true value. Add in the possibility of poor management or a lack of transparency, and you have a recipe for potential trouble. Ultimately, investing in a holding company is a bet on the people running it. You're trusting them to make smart acquisitions, to know when to sell, and to keep the whole operation running smoothly. Their track record, reputation, and incentives matter a lot, because a single bad decision can ripple through the entire portfolio. For most investors, the sheer opacity and complexity of a company like ANPA can be overwhelming. It's easy to get lost in the maze of subsidiaries, cross-holdings, and financial jargon. If you don't have the time or expertise to dig deep, you might find yourself in over your head, unless you have a clear understanding of what's inside the vault, meaning you know exactly what assets the company owns, and you trust the management to act in shareholders' best interests. Investing in a holding company like ANPA can be a risky proposition. It's not for the faint of heart or the casual investor. This is not a simple investment. Proceed with caution. Make sure you do your homework, understand the risks, and don't be lured in by the promise of hidden value without knowing what's really under the hood. Sometimes complexity hides value. Other times, it hides trouble. The challenge is figuring out which one you're dealing with before you invest. In the world of alcohol, tradition has always ruled. But now, LQR House Inc. YHC is trying to shake things up by blending the old with the new, combining established alcohol brands with the power of digital marketing and technology. This isn't just about selling drinks, it's about reimagining how brands are built and how consumers discover their next favorite bottle. LQR House is positioning itself as a bridge between the centuries-old liquor industry and the fast-paced, ever-evolving digital landscape. Their strategy is simple in theory but ambitious in practice. Harness the reach of social media platforms and the persuasive power of influencers to build liquor brands from the ground up, then sell directly to consumers. By leveraging platforms like Instagram, TikTok, and YouTube, they hope to create buzz, drive engagement, and ultimately convert followers into loyal customers. It's a playbook that's worked for fashion and beauty, but Can it work for alcohol, a category with strict regulations and entrenched players? The potential upside is enormous. If LQR House can successfully make a brand go viral and scale it nationally, or even globally, the growth could be explosive. Social media virality can turn a little-known spirit into a household name almost overnight. We've seen it happen in other industries, and the alcohol sector is ripe for disruption, but the stakes are high and the competition is fierce. However, there's a catch. Online buzz doesn't always translate into real-world sales. The alcohol business is still heavily dependent on distribution networks, retail shelf space, and relationships with bars and restaurants. Even the most viral product needs to be available where people shop and drink. Without strong distribution, even the best marketing can fall flat. The alcohol market is one of the most competitive arenas in consumer goods, dominated by global giants with deep pockets and decades of experience. These companies have massive marketing budgets, established supply chains, and loyal customer bases. For a newcomer like LQR House, breaking through the noise and capturing market share is a daunting challenge. Consumer trends in alcohol are notoriously fickle. What's hot today can be forgotten tomorrow. A brand that goes viral one month might struggle to stay relevant the next. The challenge is not just to create a hit, but to build lasting brands that can weather changing tastes and shifting social media algorithms. Financially, this approach requires significant upfront investment. Expect to see high marketing spend and, at least in the early stages, little to no profits. The key metric to watch is real sales growth, not just online engagement or follower counts. Sustainable success will depend on turning buzz into actual revenue. The experience and vision of management are crucial. Success in this space requires deep knowledge of both the liquor industry and digital marketing. A team that understands regulatory hurdles, distribution logistics, and the nuances of online branding will have a much better shot at navigating the challenges ahead. Ultimately, LQR House is a bet on a disruptive business model. It's not a proven formula, at least not yet. Investors and observers should recognize that this is an experiment in bringing Silicon Valley-style disruption to a very traditional industry. As you evaluate LQR House, look for evidence of real-world traction. Are there brands showing up in bars, restaurants, and stores? Are consumers actually buying and reordering? Or is the excitement limited to social media? The story is compelling and the vision is bold, but at the end of the day, fundamentals matter most. Revenue, margins, and market share will tell the real story of whether this disruptor can stand the test of time. In this case, the proof is in the cocktail, and only time will tell if LQR House can truly change the way the world drinks. To recap, CYCC is a high-risk biotech lottery ticket. KAPA is a business-focused, acquisition-driven play. ANPA is a complex holding company. YHC is a digital-first alcohol brand disruptor. For most investors, CYCC and ANPA are probably too risky or opaque. KAPA and YHC offer more traditional business models, but still carry significant risk. Personally, I'd be cautious with all four. Wait for more proof of success. Always do your own research and consult a financial advisor before investing. Thanks for watching. Like, subscribe, and let me know which stock interests you most. See you in the next video.